Hello everyone, welcome to my channel where I talk about personal finance. Today I'm going to talk about is 50% too much to be investing? Let's get into the video. In a world where financial literacy is growing and FIRE, which is the financial independence retire early movement, are gaining momentum, many people are rethinking traditional advice like save 10% of your income. Some bold savers and investors aim higher, much higher. One increasingly popular benchmark is investing 50% of your income. But is this extreme or is it the smartest thing you can do for your financial future? In this video, I will talk about investing half of your income. Is it too much or the right move for you? Understanding the 50% rule. Investing 50% of your income means allocating half of your monthly earnings into investing vehicles like the stock market, retirement account, real estate, or even business ventures. For example, if you earn $6,000 per month, you would aim to invest $3,000. This aggressive saving rate is championed by many in the FIRE community because it significantly shortens the time it takes to become financial independent. But it also requires immense discipline, financial planning, and usually a lifestyle well below your means. The pros of investing 50% of your income. First thing is fast track to financial independence. The most obvious benefit of investing 50% of your income is that it can fast track your journey to financial independence. Assuming you maintain a modest lifestyle, you could theoretically retire in 10 to 15 years rather than the traditional 40-year work life. Let's say your investment earns an average annual return of 7%. If you invest half of your income consistently, compound growth can do wonders. The earlier you start, the more you benefit from time and compound interest. The second thing is freedom and flexibility. Investing half your income isn't just about retiring early, it's about giving yourself options. Whether you want to switch careers, travel, or start your own business, having a strong investment portfolio offers you flexibility to pivot without relying on a paycheck. The third thing is the peace of mind. High savings and investments build a financial cushion that can handle emergencies, job loss, economic downturns, or unexpected medical bills are less stressful when you have investments to fall back on. Cons of investing 50% of your income. First thing is it may strain your lifestyle. Unless you earn a high income or live in a low cost of living area, investing 50% can put a strain on your day to day life. You may have to give up conveniences like eating out, traveling, or even living in a more comfortable home. Living well below your means isn't sustainable for everyone. It's cutting back dramatically makes you miserable. It could be counterproductive in the long term. The second thing about that is not always realistic for lower incomes. For individuals or family living paycheck to paycheck, investing 10% can be difficult. While it's a great goal, the 50% benchmark might simply be unattainable without substantial income or drastic lifestyle changes. The third thing is opportunity cost. Aggressively investing could mean missing out on experiences like travel, family events, or personal growth opportunities that require spending money. Life isn't just about saving, it's also about enjoying your journey. Additionally, putting too much into liquid investments like retirement account could leave you cash poor in the short term. When is 50 investing 50% a good idea? You have a high income and low expenses. If you are a high earner who keeps lifestyle inflation in check, investing half your income can be increasingly rewarding. Many software engineers, consultants, and remote professionals fall into this category. You want to retire early. If your goal is to retire by 40 or even earlier, you will need to invest heavily. The 50% rule aligns perfectly with FIRE goals and helps you build a solid investment portfolio quickly. You have no high interest debt. Before you invest aggressively, make sure you have paid off any high interest debts. Otherwise, the interest you are paying may outweigh the returns you are earning. When it might not be the best idea, you are carrying high interest debt. If you are paying 18 to 25% interest on credit card debt, your money is better spent paying that down than investing it at a 7% return. You do not have an emergency fund. Before you allocate a large portion of your income to investments, make sure you have 3 to 6 months of expenses saved. This protects you from unexpected costs and prevents you from dipping into investments prematurely. It affecting your mental health. Living too frugally can lead to burnout, stress, and resentment. If saving 50% leaves you constantly stressed or unhappy, it may not be the best choice for your mental well being. Alternatives to invest in 50%. If 50% feels like too much, you can still make meaningful progress with alternative strategies. One, start at 20% and increase gradually. Start by investing 20% of your income. Once you are comfortable, gradually increase your rate by 1 to 2% every 3 months until you hit your goal. Second thing is automate your savings. Use automation to remove the decision making from your investing routine. Set up automatic transfers from your brokerage or retirement account the day after you are paid. Use windfall wisely. Put bonuses, tax refunds, or unexpected income directly into investments instead of spending it. This keeps your lifestyle consistent while boosting your wealth. My final thoughts on this is 50% too much? The answer is it depends. For some, investing 50% of their income is a game changer, a ticket to early financial freedom. For others, especially those with tight budgets or high expenses, it might not be realistic or healthy. Instead of fixing on the percentage, focus on the principle. Live below your means, invest constantly, and make decisions aligned with your financial goals. Whether it's 10%, 30%, or 50%, the key is making progress. If you can invest 50% and still enjoy life, that's amazing. If not, aim for what works for you and stay committed to growing your financial future. Thanks for watching this video and do not forget to subscribe to my channel.